Is Silicon Valley Bank about to get bailed? Hello, ladies and gentlemen, and welcome back. Today, we discuss how much money is actually going to come back to investors in Silicon Valley Bank. We also talk about the key levels for the market week moving forward for both stocks, commodities, and cryptos, and the impending inflation reports. We know the Federal Reserve will be looking closely at these, and now they've got to combat a regional banking crisis. There's so much going on in markets, but we're breaking it all down together right now. Let's get into it, guys. Well, welcome back everyone to the Daily Show. This is the special weekend edition. We'll be going through the news, macro data, lead indicators, and the hottest charts that you need to be watching with the key levels. We've also got the weekly expected options moves and our thoughts on this impending CPI print. But let's get into the Silicon Valley Bank, because this is basically what everyone's talking about now. And it's a reminder that things tend to break. So what do we mean by that? Well, we've been discussing the idea that whenever the Fed tightens in cycles, basically they break something every single time. We've mentioned this so many times on the channel. Could this be the breaking point that ends up forcing the Federal Reserve to effectively pivot? We'll have to find out in the next coming days. But this week, make sure you subscribe to this channel, because we'll be bringing you the latest updates on all markets around the world. And there's going to be a lot of updates. I can't expect this story to just die down. It's going to be at least quite a few weeks of this. 20 banks are now sitting on the potential of having these security losses that happened with SVB. Basically, they didn't hedge anything to do with yields. And yeah, Silicon Valley Bank had one of the worst exposures I've ever seen. If you've looked around on the internet and Twitter and stuff, there are some absolutely shocking stories of really how exposed they were. Now, JP Morgan does have some thoughts on this, and I just want to show you how much of an outlier this bank was. But remember, there are other institutions, and generally where there is one, there are more, and that's one of the problems. But for now, the regulators are freaking out over the weekend. We've got some information coming out on that. So here's one of the JP Morgan notes, and I think this is very important. It basically shows you how much of an outlier the Silicon Valley Bank really is. Basically, we have here loans plus securities as percentage of deposits. You can see JP Morgan's pretty safe over here. Most of the banks are pretty decent. However, Silicon Valley Bank looks absolutely terrible. And these two charts really show you the story. The impact of unrealized security losses on capital ratios, it's just really bad in comparison to the other major institutions out there. So what's the fallout? Well, we've seen it in the crypto markets again, these so-called stable coins, which I must admit, I don't have that much faith in anyway. I have never had that much faith in them. USDC falling below $1, and it faces a $3.3 billion exposure to this problem. We've also got, of course, this now being one of the biggest financial busts basically since the 2008 financial crisis, which makes people think, is this like GFC 2.0? Well, certainly it shows you the cracks are there due to the historically high rate rises that we've seen. And it probably also changes what the Federal Reserve can do in terms of where they're going to get the interest rate to and when they have to pivot. So remember, there are some interesting highlights here that we need to talk about very soon. So I had to bring this up. Roku's one of the stocks that I've absolutely smashed since 2021 and even since 2020. And guess what? It's exposed as well. 26% of its cash reserves are stuck in Silicon Valley Bank. If you watch our live streams, and we will be doing a live stream for the Monday Open, so make sure to subscribe for that, you'd know that I've been pretty vocal on that one and a few other ones of these hyper growth stocks, because I just thought that they didn't make sense on paper. And it turns out it gets worse and worse and worse when you look at the way that they've actually been managing their money behind closed doors. So what's the FDIC doing? Well, this weekend, it is absolutely critical to see what they can get done. Basically, we have huge amounts of uninsured deposits, only $250,000 per entity, I think, is actually partially safe. And effectively, we have initial payouts depending on the efforts to sell these assets over the weekend. So depending on where you're watching this, you may see some updates. Now, Bill Ackman, and a few other people have said that basically people get about 50% back at this stage. Most of the insiders are saying between 30 and 50%. But what I find interesting is that there's clearly some very powerful people in this bank. People are freaking out across the world. And it's interesting to see here, the loss of deposits has the potential to cripple the sector and set the ecosystem back 20 years. So this is everybody basically having a freak out. Basically on Saturday, we saw leaders of roughly 180 tech companies sending a letter to calling the UK Chancellor, Jeremy Hunt, to intervene. I mean, we are at a world now where if you make a mistake or you get involved in a bad institution and something happens, everyone just expects bailouts. This is why it's so important to see what the Federal Reserve does. And I've got a bit of a thought process on this, and I'll share it in just a second because I posted it over on Twitter. Remember to follow at FX Evolution on Twitter. Links in the description below if you're interested. So bad economic data is going to be bad, and good data is even worse. We just saw the non-farm payrolls numbers, and they seem to be getting overshadowed. Basically, let's just talk about it. They came in hot. They came in better than expected, and what it really means is probably the Federal Reserve has to push it further in terms of stopping inflation. At the same time, they've got a financial crisis due to breaking the system. So historically, we've seen every single time there's been a financial crisis, the banks intervene, and of course, central bankers around the world, really start to get involved and say, well, we're going to stop this. We're going to plug the hole. We saw it with the Euro crisis in 22. We've seen it with, of course, recently with the crypto crisis with FTX. So this is the thing. Every time the US 10-year, and I think we need to keep this in mind in the future, breaks above 4%, something in the financial system has broken recently. And we've seen the Europe crisis, the FTX crisis, and now Silicon Valley Bank. Now, generally speaking, the system's kind of broken. So you generally see the Federal Reserve and other central bankers coming to the rescue to try to fix it and basically stopgap it. What do you think in the comments down below, though, about this? Because every single time they're getting bailed, should they be getting bailed so easily? Let's find out how fair the system is, because this one here, if you look at the gross mismanagement of money, basically to do with, realistically, you're a bank, you should be hedging interest rates. They're not doing it. That's what they didn't do at all. They literally just left it and got destroyed by this Fed hiking cycle. So what's it done to us? What's it mean to us in terms of the charts? Well, the most important thing we can be looking at here is the change in yields. Now, I know, yes, the colors are a bit hard, but don't worry, I'll show you which one. So basically, we have an incredible shift based on the last day of trade in the US, the Friday day of trade. We went from being at a 5-point, potentially 7.5% terminal rate suddenly to being 5.25, cutting off that basically 80% expectation of 50 basis points to suddenly going 25 basis points is absolutely the max that we can go to. And the Federal Reserve's being clamped at how high it can go. Look at the cut difference. So when you think about it, is this actually good for stocks that are actually healthy in the future? Well, possibly. I mean, we might be seeing a meltdown, but this is the thing. Look at the yield curve, this blue line in the middle. It's completely shifted, and I mean like a lot. So what it has been good for is anybody that's been talking about TLT. And of course, we have mentioned this a lot on the channel. US 10-year got brutalized. US 2-year got brutalized. We'll talk more on that later. And it had a super effect on one of our favorite shiny metals, which of course was gold. Let's move over to smart money versus dumb money confidence. This is the latest update I have for you on it. Basically, dumb money's freaking out, which is fair enough. Of course, we should be in many ways. It is a freaky time. But we're pulling back into some of the key levels that we'll look at later in today's show. Let's look at this, though. SPX has been dropping off, moving back now, basically wiping off everything we've put on during January of 2023. And do remember, this just shows you why you have to have patience and realistically look at the situation as much as possible. I was probably one of the last really heavy bears around 4,200. And it's because, like, for me, it's just so broken, yeah? But realistically, we held firm on that one. We were lucky in some ways the way it played out, and it didn't push that extra narrative above. But here we look now at what the market was really pricing in. No recession. So remember, no recession was being priced in. Now, most people will be talking the next couple of weeks about how we're already in a recession. We'll talk about how to figure out whether that's true or not in a few moments. But remember, the markets were literally pricing in no problems whatsoever. Now they're starting to freak out about all of the issues in the regional banking sector. So what else can we expect moving forward? Well, definitely expect earnings growth to be down. And I think forward EPS is something that we saw move negative recently. This has been allowing us to believe that even if we're not going to new lows, we're going to be in a kangaroo market during earnings season. I think the next earnings season is going to be massive, but more importantly, the forward guidance on the next earnings season is going to be huge. I also believe something that people have not done for years, which is basically thinking about the cash-free risks, is going to be a big thing. I was speaking with a big bonds manager. We're talking 10 billion plus. And he basically said to me, if you can't make over 4 to 5% above cash rate at the moment, the risks are not necessarily worth it. Now, that's not my opinion, but it's very interesting to hear bonds traders saying that in general. Now, we also know that this tends to rise during a recession. So again, it puts downward pressure on stocks. So I think we're going to be in a kangaroo style market where you may have to trade against your fear or greed in the future of 2023 into 2024. Don't expect the Fed to just come back in with this though. They're going to have to, I don't even know how you play it here in terms of the Fed, because the Fed technically should continue to put pressure on the economy to stop inflation. They tend to knee-jerk reaction, but we do know that we need to follow Fed liquidity. If the Fed pull in the market again and they say, look, we're back on, we stop the tapering, which is what this chart is showing us, basically a sell-off on assets. If they stop that or temporarily stop that, you have to expect the markets to bounce. This is not a fair market anymore. It is a market driven by central banks that plug holes that are broken in the system. I don't know if you guys agree, but they are all it's all broken. So really, we follow the Fed the most in terms of investment principles. Trading's a bit different. Of course, we go with the technicals, we go with the key levels. But investment, you have to add the Fed on top of it. There's no choice with central bank policies and the fact that the monetary system is really broken. So when the Fed pivots, we know stocks crash by more. So remember, the Fed's not going to pivot out of the goodness of their hearts. This could be the beginning of the end in terms of there is a really big problem here. It's much worse than we think. And the Fed will be forced to cut rates like the bonds market just expected to realistically say, okay, we're going to support the market as much as possible. The problem is for the first third of the rate cut cycle, we tend to see further crashes. Now, I'm not saying it's GFC. I'm not even saying it's .com bubble, but certainly a further pullback could be there due to just basically, as we saw there, the risk principles of equity, like whether it's worth actually being in stocks for a lot of big fund managers. If we look through the Friday trade, there was some reprieve. The markets rallied in the morning. They obviously moved up, which was kind of in line with our first moves, the fake move from non-farm payrolls, and then they got sloshed and broke all the way back down after that. It was a rally into dump. The markets moved underneath the 200-day moving average, which we'll look at soon. And then it was just selling more in the things like the regional banks. There was some reprieve, as we said at the end. And mostly it was gold's day. Now, why did gold do so well? It's quite simple. Yields got smashed on the curve. So we saw US 2-year and US 10-year get dumped hugely. That's super bullish for gold. I've told you they're inverted for quite some time. So really, as soon as that non-farm payrolls number came out, I said this in the private community, I said, if yields get smashed, you have to expect the rally in gold. And we saw gold go up, we saw staples go up, we saw healthcare go up, and my little utilities held as best it could. 1.57. Actually, NEE and a few others held a lot better. They seem to be the stronger utilities. Here's the 5-day rotation though, and this is where it shows you that Wall Street managed to do it again. They got into staples and utilities. They've lost money, sure, as the market's fallen off, but they don't lose as much as leaving the bags with the financials and the regional banks. 16.05% on 5 days for regionals. This has to be one of the biggest sell-offs in quite some time. So just before we jump into the key levels that you need to be watching and all of the chart analysis, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, I've got their desktop platform up here because many traders and investors need the tools available to them. And more importantly, we need customization, whether it's options, volume profiles, watch list news, or even just having a quick order window to see your positions. It's great to have it all in one window. And the good thing about Tiger Brokers is they allow you to set it up the way you wish to. So whether it's setting up extra options windows for different stocks, one-click trading, portfolio management, you can have a whole bunch of tabs across in the platform itself. A lot of them kind of get a little bit dirty. This one here is very clean and easy to set up. I also think that the most important thing as traders and investors is our time. So why not have a platform where you can set alerts really easily? Here we've got an alert being set for Tesla. Let's say I'm interested in seeing whether it can move up in a week. That could be very, very scary. Well, if it breaks certain key levels, maybe I'm interested in that. I can write them down, press OK, and then, of course, set alerts at those periods. I also love the fact that Tiger Brokers offers so many extended hours. With the news coming out about Silicon Valley Bank and all of the problems that are there in the environment, you may need to close after hours or potentially get into markets before they actually open. Having the ability to trade futures is really important. So remember to check out Tiger Brokers today, and there's a whole bunch of special offers in the links down below for many of the viewers out there in the audience. Hopefully there's one that's right for you. So let's jump into the charts now and have a look at all the key levels. We've got some big levels coming at you. The VIX is the first one. Expect volatility here, guys. Now remember, if the CPI print inflation comes in bad and we're not seeing CPI drop, I seriously think the market will probably freak out because look, there's two ways of interpreting it. One, the Federal Reserve should theoretically be raising rates at a faster rate to stop inflation. But if you've got a hot economy and a broken system, this is where the really tough part comes in. If the Fed does the Volcker moment, pushes the rates up because they have to try to get rid of inflation in the economy, then the markets will get thrashed. And I just can't see any way around that. But this is where we find these critical key levels. Let's have a look at US 2 years. They were down heavily. The bonds market's basically saying immediately, well, guess what? You've got to be supportive like you always are. You have to cut rates because we're freaking out. You've got to come back and bail us out. Will the Federal Reserve crack and agree with the market and give the stim pack that it always wants? Look at the US 10-year, another one here dropping like a rock. Of course, helping so many things such as gold and other key assets that tend to like this inversion, TLT, up all the way. If we look at the inversion, we also know a few other things that I shared over on Twitter. Basically, we usually aren't in a recession when the yield inversion's going up. It's once it turns and starts going down, a few months after that, we start to actually see the recession coming through. We still have a really strong jobs number. The NFP came in hot. So we still haven't even seen one of the leading indicators towards recession, which tends to be unemployment rising. Well, it's not. Employment is actually rising, not unemployment. So until we see unemployment rise, we can't even say that on average we're 6 months away from a recession yet. So it's a super bizarre moment when you think about it in markets. What I am pretty sure on, though, is something I posted about on Twitter, and this is why, I've said this for a while. There's only two times that people like treasuries: when they all hate them, which usually is end of cycle, and when people need them. And I'm wondering whether we just hit a moment where people need US treasuries in their portfolios. Now, it's not a solicitation to do anything. It's just a thought process. And remember, we did see some of the technical charts coming through with this. It came down to one of our key levels. It swept our lows. It created a bullish hammer, and it just finished an incredibly strong day, 3.45%. Remember this about yields. US 2-year is basically run by the Fed. So the Fed contains the short date yields. US 10-year is controlled by the market. So the market basically controls the long date. So if the market believes we're going into a recession, and also the market says, well, I think the economy sucks and it's no good, then they're going to force the US 10-year down. Now, if that happens, we'll see treasuries continue to probably rise. Of course, it's not a sure thing, but it's just interesting to see this. And I think a critical zone for TLT is going to be a breach above 109.58, which has been the previous resistance. If that happens, we could start a new equilibrium move upwards of like 117. So I think treasuries are very, very interesting on the charts. Now, at the same time, we've also used high yield junk bonds to show us that the market's freaking out in another sector. So that's been where they're very scared of basically trash companies. Now, recently we've had the pullback in trash, but trash is not underneath previous times. So it's not like the market's freaking out anymore yet. But look at the volumes. They're starting to go up. I would say that watching this HYG this week is going to be very important. High yield corp bonds, if it starts making new lows and the market starts rising, it's probably a sell the rip style situation. The bonds market tends to be more correct than the stock market, but the stock market can, of course, be greedy and fearful for longer than you would remain solvent if you were trying to go against it. Remember, people probably tried to short pretty hard recently, and it pushed us to our very brink. Even on the 10th and 15th of Feb, everyone was an ape and it was getting wild. And then all of a sudden we see the switch. Now everyone's probably turning into a big bear. And that's why we've got to be careful about these key levels that we're looking at in the market today. So first up, gold, big strong day. Obviously, it got impacted by the US yield switch, and it's a big week. Making this shift is certainly a bullish one. I will be looking this Friday. I don't have the data yet, so I'm looking towards the money flow. I need to see whether the big boys and girls are getting back into this particular asset class. But if we see a complete demolition of 10-year and 2-year yields, you will most likely see gold do pretty well. Now, I'm on the record, and I've said it before, I believe gold over the next 5 years will get to $3,000. But that's only because I think that the economies are not very strong, and they're going to require quite a lot of cuts over time, and that tends to rise or make gold do well. It's not a trade scenario, though. I don't think it's going to be there in 2 months or anything like that. So this is a very big one in terms of looking at this chart. Let's look at it on the surface. The surface is it's come back to one of our critical levels. 1867 has been literally, it literally hit it. It hit the exact area where I thought there might be some initial shorters. So I'm kind of thinking maybe some reprieve, but that's a strong bottoming and a very, very big candle. And it closed near its high. So it tends to mean that there could be further to come. I think that maybe drops as long as the US 2-year doesn't go all the way up. Probably inflation is going to be the big one. This will be the critical level. This is right where I expect bears to recommit back into the pair and have some problems with it. So be careful here with gold. It made its big move. If you were jumping on board, congrats to you. But at this stage, we're looking for money flow for the longer term. Let's move over to the US dollar. Now, you might say, well, why did the US dollar go down? The economy is so bad, everything's so bad. It's because of yields again. Remember, if you're earning less money in the US dollar, you might want to be in something else. In this case, it was treasuries that most people want to be in, or gold. So we saw the dollar break below some previous areas that were kind of important. I've got here a thought process. I kind of feel like gold just made a pretty big, dollar made a pretty big switch towards the sell-off. And this happens at a critical zone. Now, remember, let's keep it in focus here. We have a market that's going down. So this is a US dollar going down market. And because we have a US dollar going down market, we saw some stats recently to say that the rallies would statistically most likely fall off. Watch one of our videos last week where we talk about this. Make sure to subscribe again for this stuff, because I'm excited this week about all of the working parts. Of course, it's terrifying, but at the same time, this is when it gets the most exciting to actually be involved in markets, to start to understand them, to start to see these key levels play out. So we saw a switch where the markets broke underneath these last lows, effectively making a lower low. So we have a high, higher high, lower low. This should mean that rallies are met by sell demand, but it gets a bit weird with the dollar because the dollar futures left behind this massive gap, which sits at 105.64. So usually I would think that the markets would rally back up, hit these levels, and then potentially sell back off. This is the kind of way that you would usually see the markets play. I'm not quite sure on the dollar yet. A lot has to do with the CPI print, which comes on Tuesday, but I believe we should have some clarity then and start to get back to some of the key levels. What's holding up well? Well, it's copper. I'm surprised. This market really should be lower. And I've obviously, picked it from the highs here, but at the same time, I think copper should be lower. It's probably not due to stimulus and now expected stimulus of the world, because the markets are so used to the central banks just coming out and saying, oh, everything's all good, guys. Here you go, free money. It's all good. Well, maybe this time is different. We'll find out. But copper certainly still not breaking underneath 3.93. We'll have to keep watching that space. Natural gas, the old widowmaker. People love that comment there. It's coming back to our level. It's pretty much on it. This is where we expected the widowmaker to come back to. Again, the mantra of patience, guys. React, don't predict. We didn't predict much. We saw the beautiful reaction to the lows. We knew there was probably some output there. It hit like bit higher than maybe we thought, and then we get that pull back into this zone. Natural gas will be interesting to see what it does here. This is a critical level where I could see buyers come in. There are so many risks though. Remember, natural gas is like a 30% plus daily potential risk trade. It can drop 30% in a day. So if you're not prepared for that, you shouldn't be anywhere near this thing. It's coming back to a key level. I think the interaction will be important. Let's move over to the financial sector. Big close low. And this might be a tell into the next week. It didn't close on its low. It actually saw some buyers come back near the end of the day. But the financial sector broke underneath the lows. Unless it does a huge bounce rally next week, this could be the beginning of further sell-offs in financials down to 30. Do I like financials here? Probably not. I mean, I'm more looking towards, quality if you were going to go anything, but you'll see that most of the quality banks aren't sold off as much. I think what's telling is we saw some buyers come in and then they couldn't hold it above that price. So that's the finance sector. Let's have a look at the regional finance sector, KRE. Now, this one was pretty bad. I mean, you look at this and it looks shocking on the charts, just looks demolition circus. It really depends on the bailouts and what happens. We've got a gap, though, that I think is pretty important. It actually ends up being down here. So that's a gap for $41. So will we see basically a continued flash crash with dead cat bounce kind of rallies in it? So like a rally that goes to 56, everyone thinks it's all good, and then it just goes bang. I think rallies should be faded here, but it depends on key levels. And we've got one of them for the S&P 500 coming up. So, of course, we move over to Tesla. It stabilized pretty well on the Friday trade. It got brutalized last week. This comes off the back of what we believe was a distribution. The market has sold off pretty well. It's not quite at the first level. I've updated the expected weekly options lows and highs. Interestingly, the high, I think, is the interesting one. If the markets do rally, take a look where the high is. Basically, role reversal. Support becomes resistance. Critical zone. I still believe Tesla, because of impending financial issues, unless it all turns positive, because in some ways you could say, well, maybe this is actually working into the central banks' like best case scenarios. They see a semi-bank go bad, they bail it, people start to feel a bit scared about that stuff. It begins to make businesses really reassess, fire people. You could literally put a positive spin on this as an economic standpoint. And that's the thing. Unless that all happens the perfect way for the banks and the central bankers, that is, we could still see easily Tesla come back down into these zones. And this has been our most likely scenario for the last couple of weeks. And I kind of stick by it for now. I think rallies will be faded on this stock unless there's some mad central bank intervention that's just, part of the time, I guess, nowadays. We go into the big options expiration. Remember, it is the third week of the quarter this time. So we are going into the quad witching. That is going to be huge. Thursday is going to be a very volatile day. That's before the expiration day. Tuesday is going to be massive. The options are going to be everywhere. It's super volatile this week. Do not put too much risk on, in my opinion. You have to be careful, guys. Be careful out there. I really think it's going to be a big one. So here's 65,000 calls. Most likely they're going to lose the 200s, and there's no discernible strike. So anything's really possible. Max pain's usually what we look at this week, but I do think it's exceptional, let's call it fundamentals. So be careful using the options too much this week. I think maybe expected highs and lows are okay, but outside of that, using put call walls, I'm not sure about it this week. I think it's a little bit careful. Apple, let's move over to that one. It ended up actually hitting the expected options high and low last week and stayed within the boundaries perfectly. Now, we've seen sell-off. It's still a very elastic stock. This one is very strong in comparison to the rest of the market. It was only down 1.39%, while some other stocks were down 2, 3, even more. So, yeah, it's basically just coming off the sell high here. I don't see much on Apple, frankly. Let's move over to NVIDIA. Now, NVIDIA is an interesting one because we have that gap up due to the earnings announcement. Then we have a build. And if it now gaps down through the next week, let's say it just sits there and hovers on Monday and then we get inflation and it gaps down, this could be what we call an island reversal. Now, effectively, this market is being run by hype. So is it overpriced? Most likely. Does it meet any metrics by current markets? Well, I love NVIDIA, but I don't think it's cheap. It's certainly expensive. So it might need to do a bit of mean reversion. Now, if it does do an island reversal, this thing could get sold pretty brutally. So be careful here on NVIDIA this week. At the moment, it's been setting up like a sell-off event. I haven't seen it yet. There is still a case to be said for 259, but yeah, we'll watch this one very, very closely. Volume's still remaining quite high during this potential distribution. We'll move over to utilities just because I thought I'd follow something we've been talking about. It's holding better than others, but it's not doing that well in comparison. I mean, it's doing okay. I mean, it's not a new low like a lot of stocks are, but you can see here that this is where you'd expect utilities to find their buyers. So I'd be surprised if this week is not a utility week. You'd think a lot of market segments would go into it considering where it's at. It's defensive. It's got all those principles. We'll find out. And there are, of course, utility stocks that I think are really important. Now, this is an interesting chart. This is the S&P 500 versus treasuries. And you'll notice it's kind of been on this trend line for quite some time, where SPY has been outperforming treasuries for ages. This is what we call like a long-short ratio. Now, this has happened for years and years and years, as we can see. If we actually zoom it out for a long, long time, other than pretty much usually late cycle, weird tapering events, which happened over here, and realistically those types of periods, you generally see the S&P 500 outperform TLT. Now, look what happens though during a bad economic crisis period. Of course, we see people jumping into treasuries because they need them all of a sudden. Oh, we need them. We're in a recession. It's horrible. So look at this ratio. Wow, it's about to crack. So very key chart, certainly worthwhile checking out. S&P 500, here's the SPX. Now, I've put in very important zone. I think this 200-day moving average is much more than just the 200-day moving average. Everything points to that 3950, 3970 zone being a critical role reversal zone or area. And it kind of already has been one before because we saw that jobs numbers come out. We saw a nice rally coming into this zone, and then it just got flogged through the day. The first move was the false move. Now, I've got down here also a couple of key levels, unfilled gaps underneath. So anywhere between 39.40 and 37.50, I can see Wall Street buying it up. Now, you might say, well, that doesn't make any sense. This market's absolutely screwed and everything's bad. You've got to remember the market was also no good over here. It's just that it rallied like out of its own mind. So you have to think about it as you've got to go with the flow as a trader. You have to follow that trend and be reactive. You don't maybe agree with it on your long and medium term, like I've talked about many times, but your short term, hey, it was long. What are you going to do about it? It was moving up. Let's move over to the SPY. You can pause it here if you're interested. Options highs and lows. A telling one sitting at 400. If we do see an epic rally, there's going to be some sellers in here for sure, you would think. So if an epic rally does occur, the sellers are there. And interestingly, look at this, 373.24 for the low, and 375 or just underneath it is the last of those major gap fills. So again, could we swing these lows, then place a rally, then potentially dump a little bit later on? It's very much a thought process I have, and I'm always trying to think ahead. Now, this is a chart that you'll look at and you'll say, what in the hell is this? Well, there's a few things I want to break down here. First off, we broke below the weekly close. That's a pretty big deal. And I think, again, it means that rallies should be met by sell demand at this stage. We also know that we're going into what I call a major confluence zone. So we actually hit, I'm going to call it a hit, okay? Why can't I? So the markets came down and I had this as my beginning of the zone. I think it was like 3843 or 3844. And the markets actually found some buyers just there. They dumped through, and this is the way that the non-farms payrolls moved through. So we saw nice, beautiful rally, mass dump after that. So this was the non-farms number. Woohoo, we're going up. First move is the false move. Then we go down. Then we rally one last time to try to get dump buyers in, and then just absolutely slog all day. So this is what non-farms does. It tends to go off in one direction and then absolutely go off in the opposite direction straight after it. It grabs liquidity. So I'm not sure which one of these two zones is really which is the one that's super important. I like this area quite a lot. I've done a bit of work on it. I also really like this area as well. They're the two major ones that I think buyers sit on. And in terms of where sellers are, I think sellers will be through this 3,900 zone now. And of course, they're going to be there pretty much up to 4,000. In these areas, there's plenty of confluence that allows you to say, okay, well, there could be some shorters. Remember, the daily 200 sits up here as well, and that's one of the most traded zones as well. So SPX, if we look at it again, this 39.50 zone, it's super critical for ralliers. If ralliers manage to poke that daily above, all of a sudden you're saying, well, maybe this is as low as we're going. At this stage, I feel like based on the close, further selling can come through. And what's going to be the important one is CPI print. I'm not sure whether the CPI print, the scared tactics are going to push us down to these lows first. So let's say if there's mass fear, generally when that CPI comes out, you'll usually see a bit of a rally. If there's mass hype for whatever reason, then there could be the dump. You know what I'm saying? It depends on the setup coming into the CPI. Critical zones, all hopefully put on your chart so you know where the crits are this week. 5 million options in terms of what's going on here. Huge amounts of options coming through. 5 million is huge. We've got 390 as the big put wall. A few people have mentioned to me, Tom, do you think this week so many puts means the market can't go any lower? I think the market's going to struggle with going below 375. Okay, so I said this before, 375, 385, so many buyers could be in those zones, even with this hectic news. Of course, it depends on what the Fed's going to do in the CPI print. But in general, yeah, I think we're getting closer to where markets could squeeze short sellers. And I think that's important to note. Let's move over to the Bitcoin situation. And Bitcoin is pretty critical. It's moved down fairly heavily here. Big volumes coming through thanks to all of this stuff going on, plus the USDC situation and these so-called stable coins. Look, we broke through the lows. I don't like crypto right now at all. I think there's a lot of risks in here. It broke past one of my lows, but interestingly, it's trying to hold it above the weekly. I feel like this is going to be rallies met by sell. If you want to know where I think the buyers really recommit again, it's above here, a close above here, 30K is imminent. I'm prepared to sit out and chill is the way I see it. Now, if you want to be involved, of course, at the moment, the trend tends to be pointing towards the sell side, but I've kind of held that trend since we hit my watch reaction level. So yeah, at this stage, probably rips into sells. We know that where the buyers have recommitted in the past, which is at 16, 17,000 level, and everywhere in here is kind of like very questionable. If we look at the Binance or the USDC kind of coin here, the way it worked is it just basically got destroyed. Like it went from 1 all the way down to 88. That we've seen it kind of pick up in recent hours. I don't trust stable coins. Look, it's my personal opinion. You can totally disagree with me. I never have liked them. I don't even understand them. I'm not about to say that I think they're good or bad, but this just shows you the fragility of the system and you know some of the exposures that a lot of these cryptos have to serious problems in the economic system. And as the Fed's breaking things with all these rate hikes, possibly that could come out and continue to hurt the crypto sentiment. I still like Bitcoin, I still like Ethereum, but you know I'm not a huge fan of the old stables. Let's move over here to the news ahead. So we know that we're going, well, firstly, daylight savings time. Rejoice, people outside of the US. It's getting easier, especially for Australians out there, to trade. No more 1:30 a.m. starts. It's now going to be 12:30 here in Australia. We've got core CPI inflation 1 hour before the New York Open. Then we have a whole bunch of core retail sales, PPI, retail sales, another massive day of news Wednesday, 1 hour before the market open New York. So that's 8:30 a.m. New York. And then we keep scrolling down and we see prelim UOM consumer sentiment. So remember, the Federal Reserve is looking at these numbers. If the Fed decides they have to go down a Volcker moment, that's going to be super scary for the markets. That's going to force basically higher rates. The Fed's going to say we can't stop now, and things will tend to break even more. And of course, markets will freak out. Possibly that's what the Fed's been telling us the whole time. We don't want to fight them. And I will be updating you if I see the liquidity come back into the system on the back end. So if that happens, make sure to subscribe because I will be checking it out. Also, if you're interested, follow us on any of the socials. We've got a competition at the moment as well. If you follow the link, it'll be up the top. And that's free to enter just to get some of our courses for free if you're interested. And of course, remember, the sponsor of today's video is Tiger Brokers. Check them out in the links down below. And of course, there's a whole bunch of special offers as well there for members of this community. Thanks so much, guys. Have a great weekend. And remember to always practice risk aversion as much as possible. This is a unique time. And while it's exciting to be following the storylines, there's probably more on the horizon. Kangaroo 23 into 24. It's going to be a tough time, but at the same point, very, very rewarding if you can navigate it correctly. Bye for now.